For most people, there are realistically only two viable paths to financial freedom and retirement. Path 1 is long-term saving. Each month, you set aside a portion of your income, maybe 10%, 15%, or 20%, and put it into a savings account or a retirement fund. You keep doing this for 20 years, 30 years, or even longer. Then one day, you can finally stop working and begin living off the money you spent your entire working life building. This approach has been proven to work for millions of people. It is like running a long marathon. As long as you keep a steady pace, you will almost certainly reach the finish line. But it is extremely slow. Now there is a second path. This path is about buying and building income-producing assets. The goal here is not to accumulate a huge pile of money and slowly spend it down. The goal is to build sustainable streams of income that flow into your pocket every month, large enough to completely replace the paycheck from your 8-hour workday. And one important note: I am only talking about strategies that are relatively passive. We are not talking about starting a startup or building a business that requires you to work 80 hours a week. The goal here is freedom, not trading one job for another that is even more stressful. The first type of asset, a high-quality dividend stock portfolio. When people hear this, many immediately think, that's easy. Just buy the companies with the highest dividend yields. But that is one of the fastest ways to lose money. In investing, there is a critically important distinction that very few people pay attention to: the difference between return on your money and return of your money. Return on your money is the income or profit you earn from the capital you invest. This is the number most people look at first: 8%, 9%, even 10% dividends per year. But return of your money is the more important question. Will your original capital still be there 10 or 20 years from now? For example, Company A pays a 9% dividend. But its profits are unstable, its debt is high, and its free cash flow is weak. The return on your money may look attractive, but the return of your money is extremely risky. You might receive some dividends in the short term, but you risk losing your original capital. On the other hand, Company B pays only a 3.5% dividend. But it has steady cash flow, low debt, and has increased its dividend consistently for the past 15 years. The return on your money may be lower, but the return of your money is much stronger. And that is the foundation for living on income over the long term. That is why the right approach is not to focus on the percentage number, but to look deeply at the quality of the business behind the stock. Does the company have a solid business model? Does it have a durable competitive advantage? Is the balance sheet healthy, or is it loaded with debt? Is the cash flow strong and stable enough to pay dividends through multiple economic cycles? And most importantly, is this business likely to be stronger 10 or 20 years from now? When you find companies with this level of quality, you will notice that their dividend yields are usually quite modest, often around 3 to 5% per year. That number may not sound as exciting as 10%, but it is far safer and far more sustainable. This is also why having a good financial advisor matters. Finding companies like this takes time and deep expertise. A professional team that works 30 to 60 hours a week with 15 to 30 years of experience managing retirement portfolios will almost always have an advantage over individual investors like us. The second type of asset is a very classic and familiar choice for many people: rental real estate. This could be a house, an apartment, a small warehouse, or even commercial or office property. The core benefit of rental real estate is something that stocks do not always provide: a sense of certainty. Rent payments arrive in your account every month, largely independent of the wild day-to-day swings of the stock market. For many people, this tangible physical asset creates a unique feeling of security. Real estate also has another powerful advantage. With just 20 to 30% down, you can control 100% of a property's value by using bank financing. On top of that, rental income tends to rise over time, which helps protect you against the erosion of inflation. However, that sense of control comes with real risks that we need to be honest about. The world is changing faster than ever. The COVID pandemic is a clear example. It completely reshaped how we work and live, and as a result, demand for office space dropped sharply in many places. We can no longer assume that real estate will always rise dramatically in value the way it did in the past. Another major risk is liquidity. Real estate is not like stocks, you cannot sell it in seconds. When you need cash quickly, selling a property can take months, and you cannot sell just a piece of it. You cannot sell the bathroom to raise cash. Rental real estate is not for everyone. It requires effort and ongoing management. But if you use reasonable leverage and keep tight control over expenses, real estate can absolutely become a powerful income pillar to replace your paycheck. Now we come to the third type of asset. And in my view, this is the most suitable and realistic option for most people. It is a diversified investment portfolio that includes both stocks and bonds. This approach requires far less specialized knowledge than analyzing individual stocks, and it also demands much less hands-on management than real estate. With this strategy, your goal is not to maximize returns at all costs. The goal is to maintain a stable and sustainable source of income over a very long period of time, potentially 20, 30 years, or even longer after you retire. With this type of asset, your income comes from carefully withdrawing a small portion of your capital gains in a planned way. Imagine you have a diversified portfolio. Over time, the value of this portfolio grows. Each year, you sell a small portion of it to cover your living expenses. The key point here is this: you cannot withdraw just any amount you want. If you take out too much, too quickly, you start eating into your principal, and your portfolio can run out much sooner than you expect, especially during market downturns. So, what is a safe withdrawal rate? Based on decades of research, a commonly accepted and relatively safe withdrawal rate for a diversified portfolio is around 3 to 4% per year. That 3 to 4% range is often seen as a sweet spot. It is low enough to help preserve your capital, while still allowing the remaining portfolio to continue growing and offset both your withdrawals and inflation. This approach helps your portfolio last for 20, 30 years, or even longer. It is the core strategy behind financial independence for many people around the world. Finally, I want to be very clear about one thing. Everything I have shared today is based on my personal experience, research, and perspective. This is not personalized financial advice. Everyone's situation is different, and no single strategy is guaranteed to work forever. The financial world is always changing. There is no strategy that can succeed indefinitely without risk. Each person's path is unique. What I hope to give you today is not a final answer, but a map with 3 possible paths. How you use that map is entirely up to you. Start learning, start taking action, even if it is with the smallest steps. Thank you for listening. If you found this valuable, please like the video and subscribe to the channel so we can continue this journey together.